This is Randy Finney with the right side of the chart, and this is a closing market wrap for Monday, January 14th, 2019. Try to keep this one quick. Not a whole lot to report. Not a very big day in the market, relatively speaking. Of course, going back, 6, 8, 12 months ago, a nearly 1% drop in QQQ would be a big deal, but not lately. It's still more of the same with what I say those Russian dolls. Increasingly smaller and smaller candlesticks as we pushed up here, and like I said, a lot of everything else that I've went over. If you haven't caught my recent analysis, just check that out. We have the 50 days above, 50-day exponential moving average just above most major indices. You have a lot of price resistances where we really fell off a cliff towards the end of December there, and so we're back to that level now. And again, we pulled back today, so we're about let's jump on that real quick and talk about that because we're about 1/3 of the way there to the expected pullback target. 2-3% downside I was looking for, and this is interesting. I put this up in the trading room today. This market is going nowhere fast over the last week. What you're looking at is 1 week. This is Monday's open right here. Was at 159.58. So for an entire week, the market has traded sideways. The Qs is not the market; it's my preferred trading proxy. SPY is less volatile, probably even less volatility. But from the highs to the lows, I measured it out. Oh gosh, I did earlier on the site. I think this was from high to low about a 2.7% range, something like that. So very, very tight trading range, and you can see we really pretty much ended today just below where the market opened last Monday. So there it is. I should say, over a week of trading action. We were down below there today when we opened, and again, we closed below it today. So that's that. So pretty much a go nowhere market. Make of it what you want. And what I said to this, by the way, in the trading room is just one of two things. This is either a very strong market when you have a market that makes a sharp move up and doesn't have any givebacks. That's typically a very good sign. It shows you don't have sellers. It's consolidating. As I said before, there are two ways for a stock or the market to consolidate or correct or work off overbought conditions. One of those is in price, where you come down, and the other is in time. Now, it can be a combination of the two as well. You can have a mild correction, come back a little bit in price, and correct in time. But this is how the overbought conditions, near-term overbought, and what I'm referring to there, we're not overbought on the daily, just in case somebody says, well, Randy, we're not even close to the 70 level on the RSI. Talking near-term overbought conditions. On the 60-minute chart, for example, you can see that we recently hit overbought conditions. Last time where overbought was here. You don't stay at overbought very long, especially if this is a bear market rally. And that's what I wanted to talk on. So let's do something a little bit different in this video. Let's look at my long-term indicators. I spent the day studying charts, and I made mention in the trading room today that I've actually just transferred out a pretty good chunk of my long-term funds, IRAs, 401ks, transferred that out of the longs that I'd scaled into the week leading up to the lows around Christmas. Um, and I did that for a couple reasons. Last week I took a little bit, I mentioned last week, out of some small cap funds because mainly because where IWM and the Russell 2000 was. But today I decided to go across the board, small, medium, large caps, and transfer a pretty good chunk out. It's probably taken me down from, an 80+% net long exposure down to somewhere probably around 50%, if that. My plan is, if we pull back and I like what I see, I can always reload, go long again, because I'm still leaning towards more upside. But the thing about this market is, if this is a bear market rally, which a lot of longer term things indicate it is, then you don't trust it, because just out of nowhere, when things start to look good, that's when they can pull the rug out from under you and you can have a pretty sharp reversal. We're also heading into earnings season, so this abatement of volatility we've seen over the last week, don't expect it forever. But now let's do this. Let's go through my trend indicators. Flip a dime here. We'll start with the long term. So I'm going to go to this one, and you can see these are what I call it's my quad trend layout. I have a long-term trend indicators. The longest term uses a monthly chart. Then I go down. It's still a long term on a weekly chart. intermediate term on a daily, and a short-term trend on a daily. And I'll go over each of these in a second, tell you what I'm using here. So let's go to expand this one. This is the longest term. Again, it's a monthly chart of QQQ. So the black dotted line, that's the price of QQQ. No need to use candlesticks because I'm really just focusing on the trend here. And so my preferred pair for the long-term trend is a 10 and 6 EMA. So a 10 EMA and 6 EMA, again on a monthly chart. And so it's simple. Anytime you're using a pair of moving averages, you look for crossovers. That indicates a change of trend. So in this case, when the faster moving average, the 6 EMA, is above the slower moving average, the 10, so the red line's above the blue line, the trend is bullish and you want to be long. Now, what I've done to simplify that, and I did do a video, it's on the site. If you go under probably on my playlist, when you go on the YouTube channel, educational, I think is where I would have categorized this one. It's how to create a custom indicator using, you can do it on a couple different chart platforms. I've been able to replicate it on stockcharts.com, TC2000, but it's something I came up with a couple years back because I wanted to have a visual representation of when lines crossed. Also, I like the look of a histogram. You can sniff out divergences and things. So what we're looking at down below is simply a custom histogram that I created showing you when the 10 and 6 EMA cross, and also what their posture is. You know, the higher the histogram bars, the bigger the differential between the two are. And so again, when you look at this chart, it kind of gets hard to, or easy to miss the separation, the lines and what's going on. But when you look at the histogram, it's a lot easier. And now, plain and simple, here's how you use it. When the histogram is red, it means that you've had the 6 EMA cross down below the 10 EMA, and that tells you the trend's bearish. Now I can see the cross right here. So this indicator told you you were in a bear market, stay short. This is 401k stuff. I've talked about this for years, and I've had people ask me, Randy, let me know when your long-term trend indicators roll over. Well, they did recently, and I've made mention, but I want to verify or reiterate this. So you can see here's the greatest bull market in history right here. This one's only second to the one back in the 90s, and you can see green all along, it said. And I also have down below a scrubbing or alternative trend indicator. It's the ROC, or rate of change 12. Sometimes I'll play around with that number. I'll toggle the setting between the ROC 13, 12, 13, or 14 to try to, on different indexes to try to filter out some whipsaw signals. But you can see, with a few exceptions, once in a while you'll get a little whipsaw signal. But for the most part, and you go through this, it will show you the primary trends: bullish trend, bearish trend. Now that doesn't look like a lot here on this chart. We're looking at a monthly chart that goes back to 1990, but you can see it caught and told you right there was your signal. So it's the longest term trend indicators, by the way. What they don't do, they're not going to get you in and out at the tops and bottoms, because the signals, you have much fewer whipsaw signals. You don't have a lot of signals on long-term trend indicators, but they're much more reliable when you get them, especially if we start to get a few bars into here. Every now and then, again, you go back and get a whipsaw signal here or there, but for the most part, they do a pretty good job, and you can see even when they come back and test, they look like they were going to cross. For example, here's why I have the confirming indicators. We never had a sell signal on the 10/6 EMA monthly, and you had a couple red bars here on the ROC 12. So as we zoom in, let's just go ahead and zoom in. So again, it got you out of the last couple bull markets, not too far off the highs, told you to stay short throughout most of the bear markets, and had you long all the way up until just recently. So here we are. Now, I need to say this. It's a monthly chart, so all that matters really are monthly closes. Right now, the 10/6 is down into a bearish territory here, and we haven't closed it yet. So we'll see where the month closes. Last month, we did have the ROC 12 flip to a sell signal. Like I want to say, there's a little more work to be done on these. Let's just look at it. If I go out to a 13, I still have the red bar last month. And if I go to a 14, I don't. Okay, so we'll leave it at the 12 for now. And I just wanted to kind of show you that one. That's one to keep an eye on. All right, next one up, as we go down into a little bit faster pair, I use a weekly chart here. And of course, we're looking at QQQ now. If there's time in the video, I'll hit on SPY. But here's the QQQ. I use a 17 and 43 EMA. So of course the 17 is a faster EMA, it's a green line, 43 is a slower, and you can see it does a pretty good job. In fact, let me pause this and give you a longer term chart. Okay, TC2000, love the charting program, but like all, they have their limitations. I actually use at least 5 different charting platforms. I always get the question, so which ones do you use? Well, that's it. TC2000 is easy to do videos, mock up trend lines real quick. Stock charts is antiquated. You have to go into annotation mode, just add trend lines and all that good stuff. But it does have its benefits, and here I can go back longer in time. So this is the same thing. I'm using the NDX instead of QQQ, same difference. Weekly chart, same 1743. And if you're a stock charts user, again, you can check out the video how to do it, but you can see I just played around with the MACD. You just plug in, take away the signal line, put in a 0, and then you'll get a histogram there for the 2 EMAs that you're using. And so you can see what I've done here. It's the same thing. When it's green, and this goes back again to the last .com bubble, there it is. There's your sell signals on the lines. There's a buy signal right there. And you can see, so it's kept you in the trend. It doesn't look like much on the scaling here, but keep in mind this was a bull market. There's your bear market from 2008 to 2007 top. The signal came very early in 2008. And then it told you, even though the market bottomed in March of '09, it said, and it looks like about June or so, June or July, that's when you had the crossover, early July maybe, and kept you in. But the point is, with very, very few exceptions, few whipsaw signals, kept you long throughout the bull market. Remember, this was by many accounts, and some people consider this a bear market, that price act, that 2015, early 2016. We had some indexes go into bear market mode. So I don't want to even call that a whipsaw signal because, a lot of people get tied up in the whole definition of bear market, 20% drop off the highs. Whereas, Warren Buffett's famous for saying, well, if it isn't a bull market or bear market, what is it? And, most people say a bear market simply defined as the price action on stocks. So call it what you want. But again, just look how reliable it is. And there it is. Here's a point I'm trying to make. We're pretty solidly now into a sell signal on this. In fact, even more so than we were back there. What I noted here, that was a little whipsaw signal. So I think that's the only whipsaw signal in decades here. So you can see we're on sell signals on a lot of these trend indicators. So where am I going with this? Well, don't trust bullish chart patterns and bullish price action if this is an early stage bear market. There's a little more work I'd like to see done on the monthlies. And you know what? I think we'll know by the end of this month. I'll tell you, among other reasons, like I said, earnings season's coming up now. And if I'm not mistaken, we have at least 2 of the biggest stocks in the world and the biggest market leaders, Apple and Amazon, both reporting on the 31st after the close. So now, of course, what they do after earnings won't be reflected until the first trading day in February. However, point being, we should know pretty soon. We'll have a good idea of what this market wants to do here, if in other words, if these are going to prove to be whipsaw signals. But as of now, I have a lot of trend indicators. Let's go through the rest of those. I have those trend indicators on sell signals, such as this weekly intermediate term trend, intermediate to longer term trend. And let's go back and now zoom down. Next one up would be the daily intermediate trend. That's the 20 and 50 day. I talked about that one a lot. There was a lot of buzz about the 2050 death cross recently. So let's expand that one. And so there it is. Here was our what we call, now a death cross is any pair, well-watched moving average pair when you have the faster MA cross down below the slower one. So you can have a death cross on the 2050 pair, you could have it on the 5200, etc. In fact, there was a lot of hype on the 5200 crossover, I should say, but this is one that I use as a trend indicator. And it's a more of an intermediate term on the daily time frame, and you can see it's solidly in bearish territory. It's in sell signal. Last time we had a sell signal was back there. And we go back a little farther. This chart's not at full size. Again, I'm on stock charts now. And I had it back then. I was marking the buy and sell signals or the crossovers again via the histogram. But as you can see, it's done a pretty good job. And throughout the whole Trump pump and that rally afterwards, other than that sell signal it gave right here, it told you the trend was bullish. And now it's telling you clearly that trend is bearish. we'll say, the MAs are turning up, and because it is a intermediate term trend, by the time these cross over, you'll have given back some profits, if you will, on the short. Once it gives you a buy signal, in other words, the market will be up quite a bit. So the longer term the trend indicators, and again, we're using a daily chart, the slower the signals, but the fewer whipsaw signals you have. So in other words, let's go down now to my um, shortest term one on this, at least on this grid here, and that would be the short-term daily trend indicators. So I'm going to expand that. Oops, missed that. Let's see here. Try that one more time. Expand it. Okay, there's really three different pairs or three different things I'm using on here. One of the most simple and effective is a 20-day exponential moving average. That's the blue line here. And I just look for the slope of that line. In other words, when the line's pointing up, there's two ways to use it, actually. The slope of the line, which is upwards now, that means bullish. So the short-term trend is bullish, and our price is above or below it. Right now, they're above it. The dotted line here, this is where the Qs are. So by both of these, the short-term trend is bullish. However, I have a couple EMA pairs here, and you can play around with these. You get some whipsaw signals out of them as well because they're shorter term, but they're both still bearish, and they have been since this point back here. So they told you it about at this time here. I'll have to put a horizontal line up for you, but let's say right about here, it told you that, okay, this is more than a correction. The trend indicators have flipped. You may want to be short and stay short until you see these go back bullish. So, bigger picture again, this is telling us that the trend is bearish, and as powerful and as convincing as this rally has been so far, it hasn't flipped. It's only flipped some of the shortest term trend indicators back to bullish at this point in time. Doesn't mean it can't go up and flip these back. Whipsaw signals are all part of trading. That's why I have a lot of different trend indicators. And there's a lot more that goes into my trading. I'm not a mechanical trader that sits there and picks any one of these and just goes long and short every time they trigger. But I do to an extent on the long-term ones. Again, that's what I was talking about earlier, and I've been talking about for a while. Long-term funds, 401k stuff. This is the 401k type stuff, and that's why. And even in advance, I had mentioned back earlier this summer, for the first time in a long time, moving to 100% cash in the 401k back after the initial correction. And I've stayed out of there until I started scaling back in, in the week leading up to Christmas. So that's that. And this is where a long-term investor might just focus on this and maybe that weekly long-term trend, and not have to worry about all the zigs and zags that I often cover when I'm looking at 60-minute charts, futures, talking about a 1, 2, 3% pullback in the markets like I have been for the last week or so. Of course, I haven't been wrong yet. I haven't been right because the market's gone sideways, as I just showed you over the last week here. And let's wrap up there. In an extent, we've gone up a little bit. It's maybe been more than a week that I was calling for that. Waiting for a tag of this trend line. So going back, let's say, I don't know if it was 10 days or whatever it was, but we have hit it now. We've hit the trend line, but of course the trend line is dynamic. It comes in at higher and higher levels every day. So now the pullback is so far not the 3% or so I was expecting back here. So I still think we get that. We had a reaction here. We hit the trend line this morning, and we closed right on it. Another reaction. And it is support. Usually when you haven't visited a trend like this for a while, you get a decent reaction before the correction. Near term, I don't know. I don't know what happens tomorrow, but I can say this, like I said this morning, watch for a break of this trend line as well as the one I'm about to show you on ES, the S&P 500 E-minis, and that will most likely trigger a pretty decent sell signal. Again, short-term stuff. Everything has a possibility to morph into more. I'm not trying to go through this with rigid views on what the market must or must not do. So if we break down right now at this point in time, this is where I'd be looking to cover shorts 64.10 and the active trading account 64.10.50, possibly reverse long, but we'll see. We'll have to see how things look. And like I said, if we continue to push up higher, if there's another thrust up before we go back down and break this trend line, the charts allow for it. There's plenty of room here to keep divergences. Divergences aren't a be-all, end-all. It's not an absolute must, but they do tend to indicate a trend change is likely. And again, so far the divergences that we've had have played out for a sideways market. The market has stopped going up. The momentum it's hit a brick wall recently, as I just showed you. 1 week of sideways trading to slightly down in QQQ. And ES is the same story. You can see this. We've gone absolutely nowhere for a while now, just trading sideways. And ES is just dancing on that uptrend line as well. So watch for a break on both. Same story. Can ES thrust up once more? And can it do more than that? Absolutely. I just don't think so. There's so much overhead resistance at this point in time. But I do have to say, the longer we consolidate, we're working off, you're changing out hands in stocks. In other words, institutions or individuals that were able to buy in, on the way down or at the bottom here are taking profits, and you're turning over to a new set of buyers or holders in the stock. That's what consolidation does. And maybe good, maybe not. All right, let's not get tied up too much in that. Yeah, let's just wrap the video up here. I showed you the long-term trend indicators are still mostly bearish, indicating don't trust this rally. A reversal could come out of nowhere. Earnings season's coming up. But on the flip side, I've been making a bullish case since before the lows, and that bullish case is playing out. So there's cross currents, no doubt about it. There are cross currents here. And although I still think there's more upside, otherwise I would be 100% in cash right now. I think there's more upside after a pullback in the coming weeks, let's say, to maybe even a couple months here. Probably come up, maybe challenge that 200-day EMA before all's said and done, maybe even pop above it. But I'm open to anything. If we start going down and we start breaking supports, which should hold, I'll just continue to scale out of long-term funds, go into cash, and of course my active trading account. Long today, short tomorrow. Doesn't even, I try to convey those thoughts in these videos, but as of now, I think there's a little more downside even if we bounce first. I'm still looking for those other downside targets that I showed you there. Small caps, here's IWM. Just to wrap up there's that second target I had hit, and was resistance. 50-day EMA done a bang up job of containing, was support here. It's been resistance on the way down, and you can see, strong run up, and we hit it like a brick wall with resistance. So this is the markets working out these resistance. This is a battle between bulls and bears, and it's really all about supply and demand dynamics. I'm not, bull bear. I'm just speaking metaphorically. Trend indicators, PPO is down well below the zero line. That's one indicator I use on many time frames. When the PPO, I like to use a signal line, the last of the two to cross. When it's below, the trend is bearish. When it's above, the trend is bullish, and that it's a pretty reliable indicator. There's some whipsaw, especially in a choppy market like this, but in a trending market, and this is a trend, to make no mistakes about it, despite this strong rally, this is a pretty powerful downtrend, and this trend indicator is still clearly bearish. Again, you use a white line because it's the last of the two to cross, helps filter out whipsaw signals. And you can see there the PPO line is starting to turn over and roll over right around the zero line as well. And finally, we'll wrap it up here. Even SPY and QQQ, you also have the PPO still well below the zero line. You have some fibs. You can see we're right at a fib cluster. We overshot it by a bit, and there are two different fibs there. The Fibonacci retracement off the entire move down from the highs, as well as that triple top there. I picked the last high. We're there at that that Fibonacci cluster, and on QQQ there's a triple, quadruple cluster of fibs right here. You can see all the three lines I use. So the move off the highs, the move off this reaction high, and then I picked, the move off this last reaction high, and you have a cluster of Fibonacci retracements there as well as a 50-day. So like I said, anything's possible, but this market has its work cut out for it on the upside with a lot of overhead resistance levels where it's going to be met with sellers. And as I said before, just to wrap the video up with a quick fundamental look at things, when we were up here and we were just starting to go down, and nobody believed that we could fall as much as we did. And again, I was priced into the charts ahead of time, and I said what would happen. I said that you'll see two things happen, a couple things among others. You'll see economic revisions revised downwards, which we did see. We saw that after this whole thing started. And you'll see the Fed move from a hawkish to a dovish stance. They would backpedal, and sure enough, that happened. So now all that happened, and with the Fed backing off, that sparked a lot of this rally. Plus, it's all technically based. We got ahead of ourselves, like I said. We even exceeded my downside targets on the markets, not on some key stocks like Amazon and those, but um, either way, now what you're seeing is, oh, we dodged that bullet. Fed's easy again. We're going to go back to the party. No, you're going to see this at this point in time. Earnings season's coming up. You've already seen it with Apple. Samsung did the same thing right after Apple did, cutting revenue forecast. You're going to see a slowing economy. Part of it, it's a self-fulfilling prophecy or a vicious cycle when you see the market get knocked down like this, wealth effect, and then all the other issues I mentioned before, pension plans, hedge funds were overexposed to equities. Those pension funds are underperforming greatly. I talked about CalPERS and extensively in a video, how underfunded they already were heading into the year when we were up here and the market was positive. They were behind track. They have huge deficits there, and that's going to be a big problem for states like California. And believe me, CalPERS isn't the only one. I'm just picking on them because they're the biggest, but it's a systemic problem, and I don't hear enough of it talked about on in the media and all that. Of course, the student loan bubble. I can go on and on and on. But again, most importantly, this was, make no mistake about it, this isn't my opinion, this is fact. This has been the biggest credit bubble in history. It was much larger than the credit bubble where we're at now. We're only in the precipice of this thing popping, much larger than the credit bubble back in 2007. And you know what happened in the markets then. Now, I don't expect the same exact thing to happen, but once you finally pop a bubble, it continues to pop. We saw it first with Bitcoin. We saw it with the pot stocks. They're rallying now, but they're still well off their highs. We've seen it with a lot of speculative bubbles. And most importantly, the technicals now, the momentum has been broken in the market. So to me, it's just a matter of how much higher do we go, and also not to become too complacent like that video I did today earlier with the stages of a bear market. As soon as we get to that return to normal phase where everybody thinks, okay, everything's back to normal now, Fed is easy, here we go, market's going to go to new highs, we're going to have a 20, 30% year in the market again, at that point, that's when we'll start to go down. They won't believe it. The dip buyers will be doing what they did back here. They'll be buying the dip till they hit that WTF moment. They realize that buying the dip doesn't work anymore, and this is the WTF capitulation moment. So that'll be the next leg down, whether it starts from here or whether we come up here, and that would be my range. I know it's a big range, but I think it was the same range I had from before we even hit the lows, and that's still what I'm looking at right now. We will wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.